news. Stephen Bird is with us, the CEO of Standard Life Aberdeen. Stephen, good morning to you. Just put a bit more colour on the story for us if you can. I think I've run through the bare bones of the numbers. How did this period compare, do you think, to what you might be able to deliver in 2021?
Well, first of all, I think that 2020 marked an inflection point to growth for us. You can think of, there's really three things I'd highlight: momentum, simplification and growth. I'm sharing my strategy this morning, later on in about an hour's time, that really shows that the improving performance that drove the improved momentum in the second half, where our net outflows were actually 82% better than the prior period, augurs well for the recovery in the business. Now, the simplification of the business is a marked feature. It's something that the team, although 2020 was an incredibly difficult year with everybody working from home, we made a huge amount of progress in simplifying the business and getting focused on growth. We divested of non-core businesses in the Nordics. We divested and are in the process of divesting Parmenion. But we also strengthened our relationship with our largest client, which is Phoenix, who reported yesterday. And not only did we strengthen and simplify the relationship with Phoenix, but we extended our relationship with them until at least 2031. And that's augurs well for future and sustainable growth. 2021, we see the environment being very supportive. Clearly supportive monetary conditions, but when you think about, vaccines are being distributed, vaccines are working, activity, restrictions will ease, and activities will increase as a consequence. When you think about that environment, it's positive for investors, and it's very important that I think that coming out of the kind of year we had, that we focus on the future and really put our energy in to how we get together and generate client-led growth, which is what our strategy is all about.
There was an interesting line here about stabilisation of revenue yield in the near term increasing as we meet client preferences for higher yielding assets. The markets have just experienced a very interesting phase of choppiness, and yesterday in particular, where we saw the momentum tech stocks sell off very heavily, even as the cyclicals in the United States held up relatively well. To what extent do you think risks are being taken to try and find that higher yield at this stage in a marketplace where everything seems expensive?
Well, clearly, in a world of low interest rates, there is a search for yield. In our business, what I'm referring to there about stabilising yield is the strategic focus on building a private markets business where yields are higher. Of course, we've got many clients, pension funds and insurers who've got patient capital, and they're prepared to wait for those higher returns in private markets, real estate, infrastructure. We acquired a business called Tritax. Tritax is 21st century real estate. These are Amazon warehouses. And private markets is clearly a growing category. We think private markets is going to grow at double-digit rates over the next 5 years. It also refers to building our wholesale business. Our wholesale business is distributed through banks, and it's an area where we've been underrepresented. We actually did a deal with Citibank. We've gone live in Hong Kong 2 weeks ago in order to access their distribution into their clients and be able to manage our yield. Yield is not something that you just sit back and react to. You've got to focus on private markets, wholesale, and the development of your business in a manner that allows you to accrete higher yields, and that's what we're focused on doing.